Dear students, today we're going to learn about portfolio management. We're going to do it in Morningstar, where we're going to take a look at how we can actually use Morningstar to grab a series of data points that we're going to use, in this case a bunch of stocks. We will use Excel, and we have a template there available for us to use, but I want to teach you how to do it in case you'll do it on your own. So that's why we're going to look at Morningstar. So I hope you're going to enjoy it. You will have to deal with this at some point in your life. You're going to make money, and you're going to have to invest money for the future. And that means that you either do it on your own, or you hire someone that will charge you 1% of assets under management. So the question is, do you want to pay someone else, or do you want to pay yourself? So do a good job, and see you in the lecture. Morningstar offers a very sophisticated portfolio management platform. It has 3 different types of levels of membership. One is free, the other is for individuals, and the third is for professionals. But the underlying system is the same for all 3 different categories. The difference is the bells and whistles that they might have. Another major difference is that the free account is free, and you do not need a credit card to have it. The one that you sign up as an individual, the fee is fairly low. It's maybe a couple $100. But for financial advisors, they will probably pay around $6,500 to $7,500 per license. The major difference between the professional and the one they offer up for individuals is that how you manage a large pool of clients, how you download data from all kinds of custodial accounts, and sending out invoices. You don't need that. So when you sign up, you click right here, and then you add your first name, last name, your email, your favorite password that is secure, and if you're a financial professional or not. Since you're a student, you're going to click no, and then how much emails do you actually want to receive from them, plus that you agree to their terms. Once you have logged in, you can navigate through the website much better. Where you're going to do most of your work is under portfolio. This is your basic portfolio view. You can make adjustments, fairly simple, if you want different types of sizes, color, how often you want the prices to be refreshed. You can pick every 5 seconds, or if you don't want to be receiving that much content, you just keep it as is, and then you just apply. Up here you can create new portfolios, a watch list, import data, save a copy if you want, and much more. And then here you can modify by adding holdings to your portfolio. You can delete stuff. Here you have different views that you can create, and other tools such as different types of screens. You can even use different types of x-rays to look at your portfolio, and you can find all kinds of help. But here's the basic, and then you have another one where you have more information here pertaining to the portfolio that you have listed. You can always export it to Excel or print the page, and it's printer friendly. Under tracking, you have first the snapshot, but you can also click on the news part and find out what information do you have about the company that you have invested in. In this case, we can look at 3M with the ticker symbol MMM, and it lists a bunch of news. If you want more, you can click View All. You could also click on Fundamental and learn what kind of equity style box the stock has and what industry it's a part of. Under My View, you can modify how you want to have it look like by clicking Customize My View. Here you have all kinds of different metrics and statistical data that portfolio managers will use. Now, typically portfolio managers have their favorite data that they like to pay attention to. And once they have picked one, they could just add it, and it ends up right here. When you created one, in this case, I called mine the Kelly weight. I get all the data that I'll use for this example that we're going to use in class today. The Excel spreadsheet that is available on Blackboard has all these stocks in them, and you can also export your list by clicking here, and it will create a Excel spreadsheet for you, or you can print it. Once you're happy with a portfolio that you have created, you can click on X-ray to get a better idea how it's risk adjusted on different types of sectors, the Morningstar valuation box, how it's diversified in different areas. And then on the bottom, a bunch of statistics like what's the portfolio yield, what's the return on equity, and so on. Once you've done your screen, which you don't have to do for this case because I've done it for you, you export it and then open. Once your Excel spreadsheet opens up with the data that you have from Morningstar, then you're ready to go to work. In this case, I've already done it for you in the template. When we look on this list, it's very long. So now we're going to start filtering, and we'll do that by being on the home button and then click the filter button. But first we have to mark all the cells that we want to filter. So we go here and then we click on filter, which means that we get all these little drop down boxes. You will conduct a filter based on your likes, wants, and needs. In my case, I feel very risk averse right now. I'm very nervous. So I'm going to start with looking at the beta risk right here. And I'm going to take away, first of all the risks that are very low, like a negative risk, because I don't like that on the statistical part. Then I'll take away all the stocks that have a risk greater than 1, because when it comes to beta, it looks at the overall risk for the market. Oops, it disappeared, so I'm going to do it again. So I'm going to take away a few on the bottom here, and then take away all the ones that are greater than 1. So if you want stocks that are growing faster than the market, you don't want to do this. But for this case, I'm going to click away all of these. And this is going to take 100 years, isn't it? Oh, there we go. And blanks. Okay, now my list got really short. Some of these names you recognize, like Home Depot, McDonald's, Johnson & Johnson. Now, another part is that I want to check on return on equity, and I'll take away any negative return on equity because it's destroying value, and then I will probably take away the blank ones and some ridiculous numbers. Then that makes my list even shorter. And then I might take a look at return on assets and make sure that there's no crazy numbers here and it all looks good. And then I'll say, that sounds fine. Another part that I'm very picky on is that I want my companies that I invest in to pay a dividend. So if it has 0, I won't invest in it. And if it pays some crazy number like this, I don't know what's going on there, but maybe I'll just click away that one, top one, and see what happens. And then I'm going to look at price earnings. That's how many multiples you pay above at times the annual earnings. And I'll say I don't want to buy anything that is 20 times annual earnings because I want to be able to receive my money back soon enough. So I'm going to just make it a little shorter right there. Now I have a sweet little list of stocks that I enjoy. So this little filter, you can also do that in Morningstar, but in this case we're going to use Excel to do the same thing. So you're going to make your screen and screen out companies that you don't want, that fits more into the way you want to invest, your style that you're learning in school and that you maybe had experience from investing from home. Once you created this list, you will simply copy some of these cells over to your stock portfolio. And here I have a template for you, and I'll explain it to you right now. This one I've scaled down a little bit, so I only have a few of the data points. And the part that you're going to actually calculate and decide on is the expected return, where you have to calculate things, and then the probability of an event happening. Now, the exciting part is that we will use a predetermined equation right here to calculate the weight. In this case, we're going to use the weight based on John Kelly's criterion. It's a gaming theory that is based on expected return and probability of that event happening as a mean to calculate how much money to allocate on each stock. Now, John Kelly really enjoyed gambling, so he did this initially for blackjack, where he knew how many, what the expected return was and what the probability was for that event to happen, and then he wanted to have a calculation to figure out exactly how much money to bet on each hand. Now, that's a great example of using statistical measurements, but it needs to be risk adjusted for the stock market and the options market. And here you have the equation, and once you click it into Excel, it looks like this. It looks a little elaborate, so don't make mistakes with all the parentheses to make the calculation flow good. Now, for expected returns, there's different ways of calculating it. I put some ways of calculating it up here. We have also done many examples throughout the semester where you discount cash flows and calculate different types of return. Now, there's no one way of doing it, and we'll look online and you'll understand why you can't get the answer straight. I recommend that you take a look at Kelly's criterion and his concepts on gaming theory. It has all kinds of equations here that is good for different styles of investing or gambling. When it comes to expected return, I recommend that you search on expected return formula for stocks to keep it simple. And Investopedia will have some good information and good videos for you to study more. You can always look in your book for additional information. The capital asset pricing model that you can also use to calculate expected returns are explained in the book, but also here. And I should have PowerPoints available on Blackboard covering the same stuff, such as CAPM. If you're looking at using CAPM, you probably need to pull up the 10-year bond, which is used as risk-free rate of return. And then you can look at iShares, for example, S&P 500, ticker symbol IVV. And in here, you can look at performance and use a 3-year data, for example, for what the expected return is for the market. So this will S&P 500 will be used as RM, the return of the market. So you have to decide if you're going to use a 1 year, which is kind of bad because it's negative. So use positive numbers anytime you can. In this case, you have the 3-year, 5-year, and even the 10-year return available to you. You can also use Yahoo Finance to find the beta for a stock. If you need to look it up, you will click on, statistics, and hopefully that works. Let's double click on statistics. Once the screen pops up, you get some information here, and right here on this stock price history, you'll find the 5-year beta for example, Advanced Auto Parts, which is 1.08, and you'll use that for your CAPM model. If you want to take CAPM and also use the dividend discount model using this equation where the price per share will be the dividend that is being paid out. You can find that at Yahoo Finance or at Morningstar. And in this case, the R means expected return. The expected return minus how fast the stock is growing. Now, if it's growing faster than the expected return, the model will not work. It will spit out a negative number. And for probability, we're going to use a macroeconomic view of the world. So you're going to use your expectations of, will the economy grow really strong? It's going to be an averagely good year, or should it be, just plain average? No development at all in the market. Are we going to have a pullback in the market or complete recession? And so you're welcome to change these numbers based on whatever you want it to be. And then you add the probability of that event actually happening. In this case, I added 0, that I don't believe the market's going to grow at 50%. But I just threw in a number that's saying, hey, I feel fairly confident that we might grow at 27%. And I also feel fairly confident that we might only grow at 5%. Or should I say 10%? Okay. What's the chance that we will not actually grow at all? Well, maybe that's 20%, which gives us an allocation. And then I might say, okay, we just had a really strong pullback in the market that pretty much was in recession territory. But I think maybe we'll just test the bottoms one more time. And I allocated that at 20%. And if I have 100% there, I've done a good job. So this times that, so expected return times probability equals the weight. You sum it all together, and it just zooms it in right there, so you don't have to work so hard. This macroeconomic view is what financial advisors and analysts and portfolio managers do every day. Some are very sophisticated, and some are very simple. This is where finance really ends up being both science and art, okay? So it might be more on the science side, how we should calculate the expected return, where it's a lot more art when it comes to how are we going to figure out the potential weight of a portfolio. This is a type of weighting, and there's different ways of doing it. Famous portfolio managers like Jim Cramer will use a series of macroeconomic views. He will use ideas of graphs or very sophisticated bottom-up analysis. So he uses a large variety of it, and he checks it all and looks at it depending on how the market behaves. Jim Cramer is really good at figuring out what weatherman is good given different types of situations. Other ways of figuring out the weight is to actually use the whisper number from the option market, and that's when you look at the open interest and see how traders are actually investing in options, either going long or going short. We will not do that in this class. That's very sophisticated and needs a little bit of actuarial science behind it. Now let's look at one way of calculating a expected return using return on equity, the current price, and the payout ratio. So we have the equation right here, and in this case we'll look at the future stock price. Well, in this case we're really looking at what's happening, and we'll want to figure out what the expected return is. Okay, so let's click here again. And so here we have the equation, and we're going to calculate the expected return using return on equity. Now, return on equity means that if you put in $100 in at 30% return on equity, you should expect that the future price stock price should be around $130 roughly. This is 30 numbers here. But you make $30 right here, 100 times 30 is $30, but some of it is going to be paid out to investors. So if it's 50%, then $15 will actually be paid out to future investors. But assume that it's only 30% that's paid out. The rest is plowed back to the business, which means that the remainder of the money will be added to the future stock price. So here you have the equation that you can use. So you take the price right there times the return on equity and times the 1 minus payout ratio. That way you figure out the plowback ratio as a part of the equation, and you divide that by the current stock price, and then you'll find out that given the situation, you should expect an expected return 1 year from now to be at roughly 21%. Now, you can go super wild on all this and saying that, well, we expect the company going to grow and do this and it's going to do that. And that's why I sometimes call these equations to be a Barbie doll, because you can hang on all kinds of little bells and whistles to it. But we're not going to go that sophisticated. So you have the equation right there that you can use, and that helps you calculate the expected return one way. You can use other ways where you use capital asset pricing model right here, where you use a way to expect the return, also sometimes called K. I'll put K in there just so you have it in there. And that allows you to make the calculation, and for future values and expected return. You can also use the dividend discount model, where you divide the annual dividend divided by the return of the market minus how fast it's growing. Alternatively is that you replace this part right here with K, or expected return, and that's where it's important to know that it only works if I have to add this oops, damn it. It works if expected return, also known as K, is greater than G. Otherwise you get negative numbers like that. So here you have the equations that you can use to make other calculations for expected return. Once you have lifted over a bunch of stocks, you have that you have listed, and you have the price earnings, dividend yield, and all these other things, you start having a nice little portfolio that you can control and figure out the value of. The nice thing with the weight is that we'll take the weight times how much money you want to invest and let you know how many shares of each stock you should invest in. And in this case, it also lets you know how much it will cost to invest in it. And because it's a template, you're welcome to move things like from over here to down here as you work on your overall portfolio. A template is intended to give you ideas, but it allows you the flexibility of tweaking it for your likes, wants, and needs.
Dear students, I hope you really enjoyed learning about portfolio management. So naturally you're going to ask, I want to learn more. What should I do? Well, one thing you can do is read a book by Jim Cramer. He does a great job. You might want to learn something about Warren Buffett. You can do that as well. If you want to learn where Warren Buffett learned it, read this book, The Intelligent Investor. It's a fantastic book. Or you might say, hey, maybe I don't want to invest in the stock market. I want to buy houses. Well, either way, you should probably read Rich Dad, Poor Dad's Guide to Investing. It's a really good thing. And then you might say, well, I want to learn more about bonds. In that case, read a good bond book. And if you want to be a better portfolio manager and learn more about stocks, you will buy this one, okay? So either way, I think you're going to enjoy this whole thing and carry on
and never stop learning.